Hello everyone, welcome back to Swadhyay. In the previous video, we have completed revising the chapter Clubbing of Income. Now, let us revise the chapter Aggregation of Income, Set Off and Carry Forward of Losses. Generally, while computing the total income of assessee as per the Income Tax Act. First, we are going to add up all the incomes under the same head. All the income sources under the same head. We will add them up first. Then we are going to add income from each head, like income from salaries or income from the head PGBP, income from house properties and capital gains, and income from other sources. We will aggregate the total income earned from each head. After that, we are going to club the total income of assessee with income earned by any other person in respect of which assessee is liable to pay tax. That means, as per the clubbing provisions, if the assessee is liable to pay tax for income earned by any other person, we are going to add up such income too. After that, if the assessee has incurred any loss in the previous year, such losses can be set off against the income earned by the assessee in the previous year. If the loss earned by the loss incurred by the assessee is more than the income earned by the assessee, in such a case the unabsorbed portion of loss can be carried forward to the subsequent years for set off against income or profits earned in the subsequent years. So, let us see what are the provisions as per the Income Tax Act regarding the set off and carry forward of losses. Set off means adjustment of loss against the profits from another source or head of income in the same assessment year. If losses cannot be set off in the same year due to inadequacy of eligible profits, then such losses are carried forward to the next assessment year for adjustment against the eligible profits of that year. Here it is mentioned, the term mentioned is eligible profits. Loss can be set off against eligible profit only. That means not all profits can be used, not all incomes can be used for set off of losses. There are few conditions prescribed under the Act. So what are the conditions prescribed for set off and carry forward of losses under section 70 and 71 of the Act? Let us see. The first section in this chapter, section 70, talks about inter-source adjustment. Loss from one source of income can be adjusted against income from another source, both the sources being under the same head. That means loss incurred in respect of one house property can be set off against income earned on another house property. If there is a dividend income earned by the assessee, he can set off any loss incurred by him while earning income from other sources. But there are few impermissible inter-source set-off. There are few impermissible inter-source set-off of losses. Let us see what are those. The first one is long-term capital loss. Long-term capital loss can be set off against long-term capital gain only. It cannot be set off against short-term capital gain, in spite of both long-term and short-term capital gains are deriving under the head from the head income from capital gains. Both are taxable under the head capital gains, but long-term capital loss can be set off only against long-term capital gain and not short-term capital gain. But if assessee has incurred any short-term capital loss, it can be set off against either short-term capital gain or long-term capital gain. The next loss is speculation loss. Speculation loss can be set off against the profits of any other speculation business only. That means if income is earned by assessee from normal business, it cannot be used to set off, it cannot be used for set off of loss in speculation business. If assessee has incurred speculation loss, it can be set off against profits incurred in any other speculation business. But if assessee has incurred loss in other business and he has earned profits from speculation business, then loss from other business can be adjusted against profits from speculation business. Loss from the activity of owning and maintaining race horses can be set off against any income from the activity of owning and maintaining race horses only. There are no other conditions, just one simple condition is that loss incurred in the activity of owning and maintaining race horses can be set off against any income from the activity of owning and maintaining race horses. Losses from specified business. Losses from specified business can be set off against any other specified business only, income from any other specified business only, if assessee opts out of default tax regime. Loss from specified business can be set off only if assessee opts out of default tax regime. And that too, loss from specified business can be set off against income earned in any other specified business. Suppose assessee is involved in running a hotel as well as he is providing cold chain facility services. Both are specified businesses as mentioned under section 35 AD. So when assessee has earned profits in hotel business, he has incurred loss in cold chain facility services. In such a case, the loss in cold chain facility services can be set off against income earned by the assessee in hotel business. Both being specified businesses, the loss can be set off, the loss of one specified business can be set off against income of any other specified business only. And that too, if the assessee opts out of default tax regime and pays tax as per the normal provisions of Income Tax Act. But there is one more condition, that loss from specified business cannot be set off against income from other business, income from normal business of assessee. However, losses from normal business of assessee can be set off against any profit from specified business. This is the condition. One important point to be noted is that loss from any exempt source cannot be set off against income from a taxable source of income. For example, agricultural income from India. Agricultural income earned in India is exempt income. If there is any loss incurred in such field, it cannot be set off against income from a taxable source of income. I hope it is clear for you. Now let us head to the next section, that is section 71. After inter-source adjustment, that means adjustment of losses within the same head, the losses can be adjusted amongst other heads. That means loss from one head can be set off against income from another head of income. But there are few conditions. As mentioned before, only eligible profits can be used for set off of losses. That means not all incomes can be used to set off losses. So let us take the first case where loss has incurred under the head house property. Loss under the head house property would not be allowed to be set off. It cannot be set off against income under the other head if the assessee pays tax at concessional rate under section 115 BSC. But if the assessee opts out of the default tax regime, maximum of rupees 2 lakh loss from the house property can be set off. That means if the assessee chooses to pay tax as per the normal provisions of Income Tax Act by opting out of default tax regime, in such a case, the maximum amount of rupees 2 lakh only can be set off. The maximum loss of rupees 2 lakh can be set off against income earned under any other head. There is one more condition. Note this point, once a particular loss is carried forward, it cannot be set off only against the income from the same head in the forthcoming assessment years. Let us discuss what it means. So, after interhead adjustment, that means the house property loss is adjusted with the income from another head, but still there is unabsorbed portion of loss from house property. Only maximum amount of rupees 2 lakh can be set off as loss, right? So still there is some portion of loss incurred under the head house property. In such a case, such loss can be carried forward to the next year, next assessment year for set off. Such carry forward of unabsorbed loss is permitted under the head house property up to 8 assessment years, and it can be set off against income from house property if assessee opts out of default tax regime. That means once the loss is carried forward to subsequent years, it cannot be set off against income from another head. House property loss is being carried forward to the next year, next assessment year. It can be set off only against income from the house property in such subsequent assessment year. It cannot be set off against any other head income. I hope you are able to understand what I am trying to convey. The next loss is under the head business. That means business loss has been incurred by the assessee. It can be set off against any other head except for salaries head. Business loss can be set off against income under any other head except for income under the head salaries. Also, unabsorbed business loss can be carried forward for a maximum period of 8 assessment years and set off against the income from any other business of the assessee only. Once the business loss has been carried forward to the next year, next assessment year, it can be set off against income from any other business of the assessee in the subsequent years. It cannot be set off against income from any other head. There is one more point. The successor of a business cannot carry forward and set off the losses of his predecessor, except in the case of succession by inheritance. It means if the business has been succeeded by inheritance, the heirs of the business has taken over such business from the previous owner, they can set off the carried forward losses in subsequent assessment years. But if the business is succeeded by other than heirs of the business, in such a case, the successor of such business cannot carry forward and set off the losses of his predecessor. That means the previous owner. I hope you are able to understand. Now let us head to loss under the head capital gains. That means either long-term capital loss or short-term capital loss has been incurred. Such capital loss cannot be set off against income under any other head. Capital loss can be set off only against the income from capital gains head only. Also, it can be carried forward up to a maximum of 8 assessment years. A point to be noted is, short-term capital loss can be set off against any short-term capital gain or long-term capital gain arising in that year. But long-term capital loss can be set off only against long-term capital gain arising in such year. Just like we have previously seen under the inter-source adjustment, long-term capital loss can be set off only against long-term capital gain even when it is carried forward to the subsequent years. And short-term capital loss can be set off against any short-term capital gain or long-term capital gain which has arisen in subsequent years. But any loss which might be short-term or long-term under the head capital gains can never be set off against any income from any other head. Capital loss can be set off only against income from the capital gain. The next type of loss is speculation loss. Speculation loss cannot be set off against income under any other head. Speculation loss, even when we are discussing the inter-source adjustment, we have seen that speculation loss can be set off only against profits earned in any other speculation business. So, we cannot set off the speculation loss against any income earned under any other head. But speculation loss can be carried forward for a maximum period of 4 assessment years, 4 subsequent years. And it can be set off against income from any speculation business carried on by the assessee. In the subsequent years too, the speculation loss so carried forward can be set off against income from any speculation business carried on by the assessee which has arisen in such year. The income which has been earned by assessee in the subsequent years from any speculation business is used to set off the speculation loss carried forward from preceding years. The next type of loss from specified business under section 35 AD. It can be set off only if assessee opts out of default tax regime. Loss from specified business under section 35 AD can be set off only if the assessee opts out of default tax regime and pays tax as per the normal provisions of Income Tax Act. Such loss cannot be set off against income under the any head. We have previously seen under the inter-source adjustment that specified business loss can be set off against income from any other specified business only. Loss from cold chain facility can be set off against income from hotel services, hotel business. So, similarly, such loss cannot be set off against income under the any head. It is restricted only to the set off of loss against income from specified business only. But specified business losses can be carried forward indefinitely for set off. So, indefinitely the assessee can carry forward such losses and set off against income from any specified business earned in subsequent years. Loss from specified business can be carried forward indefinitely for subsequent assessment years, and it can be set off against income from any specified business earned in such years. I hope it is clear for you. The next type of loss is loss from the activity of owning and maintaining race horses. We have seen under the inter-source adjustment that loss from the activity of owning and maintaining race horses can be set off against the income earned from the activity of owning and maintaining race horses. So, it is clear that it cannot be set off against income under any other head. But such loss from the activity of owning and maintaining race horses can be carried forward for a maximum period of 4 assessment years. It can be carried forward for 4 subsequent years. And it can be set off against the income from the activity of owning and maintaining race horses only in the subsequent years. Now, any head other than capital gains, it has incurred loss. It can be set off against income assessable for that assessment year under any other head including capital gains. We know that for any loss under the head capital gains, short-term or long-term capital loss cannot be set off against income earned from any other head. But loss under any other head can be set off against income earned under the head capital gains. And we have discussed this point before too. Once a particular loss is carried forward, it can be set off only against the income from the same head in the forthcoming assessment years. That is, for the income earned in the previous year, for the loss incurred in the previous year, assessee can first opt to set off such loss inter-source, that means within the same head. After that, inter-head adjustment is allowed. That means for the loss incurred in the previous year, assessee can choose to set off such loss against income from any other head earned in such previous year. But once the unabsorbed portion of loss is carried forward to subsequent years, it can be set off only against the same head of income. Loss from house property carried forward can be set off against income earned from the house property in the subsequent years, and no interhead adjustment is permitted. Now let us discuss the order of set-off of losses. The order in which set-off of losses will be effected is as follows. First, after computing the income of assessee, we are going to provide for current year depreciation if any. And also if assessee has incurred any capital expenditure on scientific research or any expenditure on family planning. Such current year capital expenditure on scientific research and current year expenditure on family planning is allowed. After that, we are going to provide for brought forward loss from business or profession. Then the assessee can choose to provide for unabsorbed depreciation. Unabsorbed depreciation means depreciation which has been carried forward from preceding years. Also, the unabsorbed portion of capital expenditure on scientific research and unabsorbed expenditure on family planning which has been carried forward from preceding years can be set off with the income earned in the current year. A point to be noted is that as per section 80, filing of loss return under section 139(3) within the due date specified under section 139(1) is mandatory for carry forward of above losses except loss from house property and unabsorbed depreciation, which means in order to carry forward the above losses, if there is any unabsorbed portion of loss, in order to carry forward such losses, the assessee must file loss return within the due date specified under section 139(1). I hope it is clear for you. So, this is all about the chapter aggregation of income, set off and carry forward of losses. I hope you find this video helpful, and let us discuss the other chapters which are left out in the upcoming videos. Please keep watching our videos and thank you for watching this video.